We're here at Schwab Impact 2018 in Washington, D.C. This is one of the biggest advisory conferences of the year and probably in the country. Over 5,000 guests are here, from technologists to fund providers to advisors, all looking at where this industry is going. And what we're trying to do is bring together some of the best minds and thought leaders in this industry, from technology to RIAs to product providers, to help give us some perspective into where this industry is going. And today we're lucky enough to have Tim Gilligan of Legg Mason join us, who has been in both tech and product, which is going to make it fun. So tell everybody a little bit about yourself, what you're doing at Legg Mason, and a little bit about Legg Mason.
So I've been at Legg Mason about 3 years. I'm presently the head of ETF Sales, covering our wealth management channel, which would include RIA firms as well as family offices and bank trust departments. So in total, I've been in the industry about 20 years, and you're right, it's spanned across multiple aspects of the business, including product, distribution, as well as technology.
Yeah, and speaking of product, right, ETFs have burst onto the scene now. I've been here for what, 26 years roughly,
That's right.
since
Yep.
IVV or SPY really first came out. And there's a lot of innovation. We talk about innovation on the technology side, but we can take a second and talk about innovation on the ETF side, about, you know, where is that going, right? Fees are coming down, but as a product provider, what are you all looking to do to help continue to get adoption of new ETFs and solve problems for RIAs?
Yeah, you're definitely right. I mean, if you look back over the last 20 years, if you were to ask me what was one of the more disruptive events from a product standpoint in our industry, it would definitely be the development of the ETF Wrapper. And you can just see it in the cash flows, and especially since the great financial crisis, the amount of cash flow going into ETFs has been just extraordinary. And if you look back at the flow and sort of the sequence of how that's happened, I think the first iteration of this is primarily all the flow's been going into market cap passive. We see those numbers today, and they're pretty staggering. Second wave of this has been in sort of your smart beta rules-based strategies, and now about 20 cents on every dollar is going into those strategies. So at Legg Mason, we actually think we can find a very healthy niche in this industry, right? Because those two categories, smart beta and market cap passive, are increasingly crowded, and we see that in fee compression as well. But at Legg Mason, we're $755 approximately billion global asset manager. It's no secret we pride ourselves on active management, and we think the world of ETFs and active management can actually come together. In our former life, we actually used to educate financial advisors on sort of the differences and pros and cons of an ETF versus a mutual fund wrapper. And at the end of the day, we find an ETF wrapper and a mutual fund wrapper have much more in common than there are differences. Both Act 40 products, both subjected to similar rules and regulations under that, both open-ended products, both can do the create-redeem process. The big difference is, on average, an ETF is about 15 to 20 basis points cheaper for us as a fund complex to operate, again, assuming all else equal there. So we think if it's just a wrapper, we can take this wrapper, put it around our best actively managed strategies, bring it to market cheaper and more tax efficient, which we think is a great thing for the end client.
And you mentioned you spend a lot of time talking about the difference between ETFs and mutual funds, and that education. That education has been going on now for a couple of decades. So does that education need to continue to get more adoption, or does the education shift to somewhere else to help people adopt or ETFs a little bit more? Is it always going to consistently be an education about mutual funds versus ETFs, or are you going to start educating people on the efficiencies of how you build it out, the ETF, or is it going to continue to expand? How do you see that playing out?
Well, you know, for all this talk about technology and sort of it being sort of a big disruptor in our moment of time here, just as we don't think technology is going to put financial advisors out of the business, we also don't think technology is going to put wholesalers out of business. We actually think technology is going to make wholesalers better at what they do. So we do think, just as we're on this constant continuum of change, we're also on this sort of constant continuum of what we communicate to our investors. And we do see sort of an uptick in sort of the acceptance and understanding of what ETFs are, not only by financial advisors, but their end clients. So now it's just more of a medium of, one, how do ETFs, how are they used in a portfolio, and what can clients expect from their ETFs and their portfolios under certain market conditions. So when we're looking at technology, it's for us, we're trying to figure out not only ways that we can better distribute our product, but also how can we take information and get it into our hands of our advisors and get it into the hands of their end clients, which, by the way, are two very different communication styles, because advisors and retail clients certainly, absorb information very differently. So technology has certainly not only changed many aspects of the financial advisory business, but also for us, it's how can we leverage it to put information in the hands of investors.
It's kind of taking it that level deeper, right? I mean, the advisor may want to know about Sharpe ratio and beta and how it all works and the alpha that it generates, but when you start talking about that to an end client, their eyes gloss over and it doesn't do any value. So how do you bottle that up and effectively communicate it to the end client? Technology can help with that.
Yeah, absolutely. So we distribute 100% of our product through a financial advisor, but that certainly doesn't mean that we're not aware of what the end investor needs and wants. Right? In many respects, when we're trying to figure out what is a solution to a problem, and we find ourselves being too Legg Mason centric, we reverse the equation and we ask ourselves, what does the end client need? Because we know, even though that financial advisor is using our product, that financial advisor has to then take our product and communicate it to the end clients. So anytime we're producing communication materials, we're producing it on multiple levels, right? We want to be able to communicate at a more sophisticated level to the financial advisor, but then hand those materials over to the client, the advisor, so that they can then have the conversation.
They can leverage it there. So let's speak real quick. Let's shift over to our industry as a whole and outside of ETFs and look at it kind of from a macro perspective. Lots of headlines swirling from fintech to ETF innovation to robo-advisors, whatever it may be. What are two of those headlines out there that give you, being in the industry, the most worry today?
Yeah. So one is, I think, overreaction, right? I think there's been a little bit of that on my own part, to be candid with you, which is to say that if you listen to the headlines and you listen to pundits, you would hear, hey, the robots are coming, the financial advisor value proposition has completely changed, the portfolios have been commoditized, and the only spot that a financial advisor can add value is through financial planning, right? And so while we agree that disruption is here and change is happening, we kind of remind ourselves and take a step back that we're just on this constant continuum of change. So one, we're a little worried about just an overreaction to change. We want advisors to change. We want them to get better at what they do. We want to get better at what we do, but we don't think that necessarily means giving up on the portfolios. We don't necessarily think that that means that everybody's portfolios should look the same and is completely commoditized. And to be candid with you is, traveling the country and talking to thousands upon thousands of financial advisors, we do see a little bit of that. We do see financial advisor portfolios that are strikingly looking more and more similar.
And that, I mean, let's just talk about the challenge that presents, right? That you talk about systemic risks to the market, right? If you have everybody buying and selling the same things, everybody's emotions are usually going to be high and low at the same points, which you talk about, the flash crash and everything of that nature. When you're going to start seeing swings and volatility if everybody's trading the same things at one point in time, which then puts pressure on you as a product provider and an AP to make sure the market doesn't move that much.
That's right. So right now, I mean, you're starting to see some more press today just about the size of passive and what are the implications of that. And I don't know that I have a strong opinion one way or the other, but it certainly is going to be interesting to watch it all unfold. Bloomberg just put out an article that suggests that the three big providers of passive could own 25% or so of every publicly traded company by, we'll call it 2023, 2025, which is just staggering, right? And so there are real implications to that across the entire industry. What those implications are and whether it's positive or negative, I don't know, but it will be certainly interesting with time to watch that all unfold. And to your point, I mean, about when it comes to portfolio construction, regardless of how an investor is getting access to that portfolio, if they're getting it directly through a B2C robo-advisor, it doesn't mean that client's emotions have completely evaporated.
Right.
It doesn't mean that they're not capable during a flash crash or during some kind of systemic risk environment that they're not going to get onto their smartphone and hit the sell button.
Yeah, which then still puts pressure on everybody involved and the markets as a whole. So let's flip that question. We said what worries you most. Overreaction is a big one. What excites you about these headlines that is going on in this industry today, which is, we look back 5 years, it's quite drastic where we are today. What excites you within the financial advisory space?
Yeah, I think anytime there's change brings opportunity. And at Legg Mason, we pride ourselves on active management. We own 9 different affiliates. Western Asset Management, ClearBridge, kind of being two of our largest affiliates. And underneath of our corporate, mission statement is investing to improve lives. But underneath of that, we have a corporate strategy, which is product diversification. So we want all of our affiliates for every strategy to be able to offer all of their strategies into different vehicles, right? So we want if you as an advisor have different client types and you like a strategy, we can give that to you in an ETF, we can give it to you in a mutual fund, an SMA, a CIT. So that way, maybe for the retirement plan, the CIT works best for you. Maybe for your high net worth clients, SMAs or ETFs work better for you. But the reality is for you as an advisor, you only have to oversee one strategy, but now you have a customization of the different vehicle type. And so I think that presents us opportunity because some of those vehicle types are cheaper, and cheaper is generally a good thing for the end investor. And I think that presents us with ample opportunity. And I think the good thing is, we have a whole department within Legg Mason called our alternative distribution team.
Yep.
And as you know, they're working very hard, not only just how do we leverage technology to distribute product, but again, it's how do we get information into the hands of our investors. And we're certainly not afraid of the democratization of information. We almost want our financial advisors to know more about us before we actually walk through the door, because that puts us in a better position of helping that financial advisor and their end client to do just that, invest to improve lives.
Gives them confidence. Transparency, information gives you confidence, which is why we all use Uber every day, right? We know when the car is going to be there, we know how much it's going to cost, and we know when we're going to be at our destination. It tells us right away, whereas with cabs, it didn't tell us that.
That's right.
I want to shift real quick to technology, and then we'll kind of wrap it up. But on the technology front, you've had experience in the technology world, and you've seen some of these these younger companies or these startup companies evolve into bigger brand names. What is the future of the fintech ecosystem in your mind? Are they going to take over the big names? Right? Maybe not. What type of role are they going to play within the whole financial landscape ecosystem?
This is really fascinating, and ultimately I don't know, but here's I think what we've watched unfold so far, which is some of the startups who just deserve such extraordinary praise for taking ideas, incubating those ideas, and bringing them to market and having proof of concept there to the point where it's caused all of the big players to really wake up and start to invest in technology. One of the things in the robo-advisory space is, just this idea of automating the portfolios and making the whole process of creating an account, funding the account, tax loss harvesting, rebalancing, making that all very, very simplified. And I think the benefits of that have already kind of transcended and kind of made its way into the advisory community, and it's also made its way into the asset management community. So the way I see the advisory community kind of leveraging this technology and the way it's evolving is, financial advisors should be working very hard to get themselves out of the back office and spending more time with their end clients, right? Because if we do run into a situation where all these portfolios start to look the same and it's commoditized and it's hard to kind of create a value proposition around it, financial advisors need to pull themselves out of that back office, spend more time with the end client. So what does that mean? Less paperwork, make it easier for your clients to open accounts, using technology to communicate better with those clients. And I think the smaller startup technology firms are probably in the best position to help financial advisors achieve that. Because one, they're oftentimes financial advisors themselves. They understand all the back office operations of a financial advisors. They all understand the pain points, and that's where a lot of innovation comes from. That oftentimes it's hard for big asset managers to do that. The challenge is, if you're an RIA firm and you adopt digital technology, the challenge is, it doesn't mean 1 million investors are going to show up at your front door and start to invest with you, right? There's still this client acquisition cost. And that's one of the things the industry is learning is technology is still a way to spread fixed cost across a lot of different clients. And brand matters a lot, right? So if you're a firm that already has 1 million investors on your platform and you already have clients walking in your front door, digital technology is going to help you an awful lot because that's a scaling mechanism for you. And that's what's really going to drive fees lower from the bigger players, and it's going to put more pressure on not only other asset managers but financial advisors as well to deliver value at a lower cost.
Yeah, and that's interesting because it talks about how it can help and it will work and it can add value. It's not going to replace the advisor. You sit across the table from advisors every day, and Legg Mason, in many eyes is an asset manager, but you have the ability of helping them with practice management and everything from that nature. Why is it so hard right now? And you've also been a distributor of technology, so you sat across on that side too. Why is it so hard for advisors to adopt new technologies? Where is that hurdle coming from? Or are we seeing it wrong and they actually are adopting a lot of technologies? What is that kind of hump that they need to get over from that standpoint?
Yeah, I think some of it's behavioral. And in some respects, advisors have been doing business a certain way for a long time and it's worked, and they don't really see any need for change at the moment. And especially because if you think about a generation of financial advisors that have grown up over the last 20 to 30 years in this business, many of their clients are of similar age, right? And I think a lot of the disruption from technology will eventually come from a younger Gen Z, millennial type of demographic that's growing up with access to information, is accustomed to having everything democratized and for free. So as that generation comes up to speed, I think that's where we're going to start to see a little bit more disruption if I had to venture a guess on it. But in some respects, I think providers of technology need to do a better job of helping financial advisors understand the net benefit to them and also how it integrates with the rest of their entire suite of technology. And I think that's the holy grail of technology is a financial advisor today can say they have rebalancing software, reporting software, CRM, etc., but it's kind of loosely duct taped together. Question is, how can we stack it all on top of each other so it's seamlessly integrated?
I mean, that's the thing that I see with our business. My dad started 25 years ago, and you just add new technologies, and you have that technology solve a specific problem, but then you're now inputting information into 3 different pieces of software, and then you're wondering, why am I not getting the full value out of this technology solution? It's because there has to be this thought process, which if the technology companies have taught us anything, is think a little bit more like a technology company. Like, what is my tech stack? How does everything integrate together to create the efficiencies? Because the efficiencies of technology really only come when it integrates into your processes and it streamlines things, which you need to have that kind of bilateral communication.
And I think that's where I see the best firms right now, and it's hard for me to judge who is the best firm and who isn't, but the firms that excite me for their future are the firms that are taking younger, innovative technologies and iterating, right? Trying it out, learning, being curious, and just trying to figure out, will it make them more efficient at what they do? Will it take them out of the back office? Will it do something as simple as scheduling appointments? Will it help as something as simple as reducing the amount of paperwork that you're pushing, reducing the need for the number of people in the back office, but more importantly, just spending more time communicating with their end clients. All
right, I'm not going to let you go without taking the crystal ball out. This is a conference where a little bit higher up, the mic when you're talking. So investment conference, everybody's talking about predictions of where the market's going, right? Everybody wants to know, what's the economy doing? What's the world look like tomorrow? So I'm going to ask you, 5 years from now, how does the financial advisor client relationship look different than it does today? What is the future of this industry 5 years from now? And what can a financial advisor look at and say, my world is different than it was 5 years ago? How does that world look?
One, I think top down, especially in the RIA space, we're still seeing a lot of interest in merger and acquisition activity. And I don't know if this falls under the camp of overreacting or not, but we're certainly seeing a fair amount of RIA firms getting larger. And I think you're going to start to see a lot of RIA firms as they get larger and have more financial flexibility, trying to figure out how they can, one, not only communicate better to their end clients, but also reduce the need on model portfolios, right? And so that's the fine line that technology is really trying to help an RIA straddle, which is how can we have scale across our business and build a customized solution for that end client. And so I think you're going to start to see, with firms becoming larger, greater financial resources, you're going to start to see a lot more innovation and a lot more ability to leverage technology to build a customized not only portfolio, but overall experience for that end client.
Love
so
it.
RIA firms are going to get bigger, and we're just going to continue to just see ways of more efficiently enhancing that portfolio and client experience.
That's awesome. Tim Gilligan, Legg Mason, if you want to continue to hear the knowledge that he spews, which is always really beneficial, go follow him on LinkedIn and go give him a shot. Talk to him at Legg Mason as well. Follow me, subscribe to the channel, and we're going to be back with some more interviews here at Schwab Impact 2018 from Washington, D.C. Thanks again, Tim.
Matt, thank you.